For many traders, the biggest challenge is getting in on a new trend before the main move is already over. In this video, I'll teach you the bow tie strategy, a powerful method designed to spot the very beginning of a trend with simple objective rules. By the end of this lesson, you'll have a clear step-by-step plan to trade with more precision and confidence. Welcome, everyone. Today, we're diving into the bow tie strategy. At its heart, this is a pure trend-following system designed with a single clear purpose: to capture the start of a new directional movement in the market. This strategy is built upon two core principles: the precise alignment of three moving averages and a classic breakout pullback price structure. This combination results in a method with simple, objective rules, making it ideal for identifying trend reversals. Furthermore, its principles are robust enough to work effectively across various timeframes and markets. Alright, let's get into the chart setup. The entire strategy requires just three moving averages. We'll start with the first one, a 10-period simple moving average, the SMA 10. This indicator will track the market's short-term momentum for us. The second indicator is a 20-period exponential moving average, the EMA 20, which gives us a medium-term perspective. To complete our setup, we add the third and final line, a 30-period exponential moving average, our EMA 30. This will serve as our guide for the underlying long-term trend. The power of using these three indicators together lies in how they define a trend's transition from one state to the next. It is critical to understand, however, that our final signal is a two-stage process. It requires first a moving average crossover, which is then confirmed by a subsequent price breakout. Let's see what this looks like on an actual price chart. The bright green line is our short-term SMA 10. The yellow line represents the medium-term EMA 20. And finally, the red line at the bottom is our long-term EMA 30. This is the visual layout we will be working with. Now, let's define the precise rules for identifying the bow tie pattern for a long setup. There are two conditions that must be met. First, the moving averages must align in a specific bullish sequence. The SMA 10 must be greater than the EMA 20, which in turn must be greater than the EMA 30. Second, the price itself must achieve a candle close above all three of these moving averages. This specific stacking of the moving averages is what confirms the underlying momentum. With the fastest average on top and the slowest at the bottom, they begin to fan out. This visual cue signals that a clean and strong reversal structure to the upside is taking shape. And here we can see that perfect alignment directly on the chart. Notice how the green SMA 10 leads the pack, followed by the yellow EMA 20 in the middle and the red EMA 30 providing support at the bottom. This is the exact bullish structure we are looking for. With the moving averages correctly aligned, we now look for the second condition to be met. And right here, we see a candle close decisively above all three lines. This price action confirms the breakout, validating our long setup and telling us it's time to start looking for a precise entry point. This chart perfectly illustrates the bow tie crossover that gives the strategy its name. You can see the exact moment the moving averages cross and begin to fan out. This clear separation is the key visual signal that a new, powerful trend is taking hold. Now for the entry, and this requires discipline. After the breakout, we do not chase the price. We must patiently wait for a specific pullback, a candle that makes a lower low than the previous one. This brief pullback is a sign of a healthy, sustainable trend. It acts as a confirmation that the initial breakout wasn't just a random spike. Our actual entry trigger occurs only when the price breaks the high of that pullback candle, signaling the uptrend is likely to resume. Before taking any trade, however, we must apply two critical filters. We will immediately discard the setup if the moving averages lose their clean, bullish alignment. Secondly, we must completely avoid taking entries when the market is in a consolidation or moving sideways. This strategy is for trending markets only. Let's walk through a complete long entry example. On this chart, the bullish setup is already confirmed. The next crucial step is to wait for a pullback. We are now looking for a candle that makes a lower low than the previous one. Let's rewind to see how this setup formed. It all began here, where the moving averages crossed and settled into the correct bullish alignment, with the SMA 10 on top, EMA 20 in the middle, and the EMA 30 at the bottom. After the alignment, we got the second confirmation. The breakout. This strong candle closed firmly above all three moving averages, signaling that buyers were taking control. This is what officially validated our setup. Which brings us back to our entry phase. After the breakout, we needed to wait patiently. This small red candle is the exact pullback we were looking for, as its low is lower than the previous candle's low. This is our cue to prepare for entry. And here is the final step: the entry trigger. We enter the long trade on a break of the high of that pullback candle. The moment the price moves above this level, our trade is active. This chart shows a perfect example of what to avoid. The moving averages are flat and intertwined, and the price action is choppy. In a market like this, the strategy is not applicable. We only hunt for clear trends, so any sideways movement is a signal to stay out. Now, let's flip the logic and define the rules for a short setup. The conditions are the mirror opposite of a long trade. First, we need a bearish sequence. The SMA 10 must be below the EMA 20, which must be below the EMA 30. Second, the price must secure a candle close beneath all three moving averages. This bearish alignment, with the fastest average on the bottom and the slowest on top, confirms that sellers are in control. This structure fanning out to the downside is a strong visual indication of a potential downward reversal and building bearish momentum. Here is a clear chart example of a short setup. We can see both of our rules being met. The moving averages have crossed into the correct bearish sequence, and the price has decisively broken down, closing below all three lines. Let's focus on the structure. The fast SMA 10 is leading the move down, the EMA 20 is in the middle, and the slow EMA 30 is on top, acting as resistance. This clean separation is exactly what we need to see to confirm a potential downward reversal. This clean fan out of the moving averages, highlighted here, is the key signal we are looking for. It visually confirms the shift in momentum and tells us that a potential downward trend is now in play. This is what gives us the confidence to proceed with the setup. Just like our long setup, the entry for a short trade also requires discipline. After the price breaks down, we do not chase it lower. Instead, we must wait for a pullback. For a short trade, a pullback is a candle that makes a higher high than the previous one. This brief bounce creates our short pullback setup. The entry is then triggered only on a break of that pullback candle's low. It's also crucial to apply a filter. If the moving averages flatten out or begin to reverse during the pullback, the trade is invalid. Let's see this on the chart. After the initial breakdown, the price action pauses and forms this candle with a higher high. This is the exact pullback we need to see. Now we can prepare our short entry order. The final step is the entry itself. Our trade is triggered the moment the price breaks below the low of that pullback candle. This action confirms that sellers have overcome the brief pause and are resuming control, pushing the price lower. Here's another look at our short pullback setup. The market breaks down, provides a small bounce against the trend, and then prepares to continue lower. This brief pause is our low-risk entry opportunity. And here again is a visual reminder of our critical filter. When the moving averages flatten out and lose their downward angle, there is no trend to follow. In this environment, we do not take any trades. Patience is key. Now, let's discuss the most important part of any trade: risk management. For a long trade, the stop-loss placement is simple and objective. We place it just below the low of the candle that triggered our entry. For a short trade, the rule is the mirror opposite. Our protective stop-loss is placed just above the high of our entry candle. This ensures our risk is always predefined and controlled from the start. This specific placement provides two key advantages. It gives us very precise risk control on every trade, and it also establishes a clear invalidation point. If the stop is hit, our trade idea was wrong, and we can exit for a small, managed loss. Let's look at our long trade example one last time. After entering the trade, our stop loss is placed right here, just below the low of the entry candle. This clearly defines our maximum risk for the trade. And here is the placement on our short trade example. Once our entry is triggered, the stop loss goes just above the high of the entry candle. Our risk is immediately contained and under control. Regarding profit targets, a simple method is to aim for a fixed risk-to-reward ratio, like 1:1.5 or 1:2. We can cover more advanced exit strategies in a future video, so let me know in the comments if that's something you want to see. And that completes our guide to the bow tie strategy. If you found this video valuable, please take a moment to like the video, share it with other traders, and subscribe to the channel. Don't forget to turn on notifications to catch all future lessons. Now I'd like to hear from you. Please leave a comment below. What are your thoughts on this strategy? And what other trading concepts or strategies would you like me to cover next? Thank you again for your time and attention. Always remember to keep learning and keep improving your skills. Happy trading